So, one of the more interesting developments that's taken place in the investing world over the past few years is this meteoric rise of passive investing. For many years, investors believed that it was worth paying higher fees for actively managed mutual funds or actively managed ETFs because a good active manager could produce far superior returns, which would compound a lot faster over time. But what the data is starting to tell us now is investors just simply don't believe that that's true anymore. And when you throw in all of these low cost investing brokerages that have been created recently, where pretty much anyone with a little bit of money can get started in investing. What you're really starting to see now is investors embrace this DIY approach to investing and they're managing their own portfolios. They're not going through financial intermediaries like banks or financial advisors because that's just the sensible thing to do, right? They can save a lot on fees, which again, saving on fees when you're compounding returns into the long term does end up making a very big difference. So what I want to do in this video is talk about number one, why passive investing has become so popular in the recent years. And then I also want to kind of refute this claim that's kind of been floating out there, which is that passive investing has somehow broken financial markets or equity markets in particular. They're not operating based on fundamentals anymore. They're just operating based on whatever the passive index funds are tracking. So a company's inclusion in a given index. So I want to talk about that. And then I also want to look at some historical data to see how well has active management actually done relative to passive investing over the past few years? Is it as bad as we think, or maybe is there still some legitimacy to actively managed funds? Are they doing well enough that we should still consider them? So let's look at some data to add context to this whole discussion. So this chart I'm showing on screen here, this is data from Morningstar, and what it shows is since 1993, so pretty much 30 years now, the total amount of dollars invested in passive funds in the pink versus actively managed funds in the blue. And what we can see here is that early in 2024, for the first time in history, passive assets has now surpassed active assets, which is something that, has been coming for a long time. It's not exactly a surprise, but it did finally become official in 2024. Now, the more interesting way to view this data is this chart, which shows the divergence that's happened in passively managed versus actively managed funds. And we can see it goes back to 2000, and from 2000 until 2008, actively managed funds were consistently higher than passively managed funds. But then around 2008, so when the financial crisis happened, you saw this dip in active funds and a slight uptick in passive funds. And pretty much since then, passive funds have been increasing, and we've seen active funds just basically get to a point where they're actually now negative. So clearly, there is this drastic fundamental shift that's happened, and it all kind of started in 2008, which I thought was pretty interesting to learn because obviously that's when the global financial crisis happened. And maybe that had more to do with the fact that, it was just a financial crisis and also had something to do with people's trust in Wall Street and trust in financial institutions where they don't want to be invested in actively managed funds, which you commonly find on places like Wall Street. They would rather just invest passively and again embrace this DIY approach where they're not going through banks or financial advisors. So maybe it has something to do with people's trust in financial systems. I don't know, but it was pretty interesting to see that that's kind of all when it started, right? And before that, it was actively managed funds were actually increasing at a higher rate than passive funds. But as the fund flows now show, actively managed fund or passively managed funds are significantly higher than active. Now, Morningstar publishes this semi-annual report that looks specifically at passive versus active fund performance on a more detailed level. And there's some pretty interesting stats in here that I wanted to just quickly talk about. So, for one, they're looking at what they call the success rate. So, the percentage of active funds that outperformed their passive peers. And in the year 2023, which all things considered was a very, very good year for stocks in general, they're looking at US stock pickers that had a 46% success rate in 2023, which was down from 49% in 2022. So the odds of an active fund beating a benchmark is actually less than 50%, or at least it was in 2023 and the year before in 2022. The best cohort of this was active large cap managers, which had a 49% success rate versus mid cap, which is 42, and small cap, which is 41. So, and this was the lowest level of the success rate in the past several years. So 2023 was not a great year for actively managed funds overall. And then what's also interesting to note is when you look at more expensive actively managed funds versus cheaper ones. So what they're looking at here is basically 10 years through December 2023. And again, they're looking at this so-called success rate. So the percentage of active funds that outperformed the most comparable benchmark, so the S&P 500, for example. And over 29% of active funds in the cheapest quintile, so the lowest 20% in terms of their annual expense ratios, beat the average passive peer. So 29% of those cheaper active funds were outperforming, a benchmark index. Compared in the most pricey quintile, it was 18%. So this is interesting data because it shows how much of a difference fees can make, right? And it also shows that paying more fees for better active management supposedly isn't going to be worth it most likely in the long term. And they're looking at 10 years here, which is definitely what I would consider long term. And the fact that, just based off of the price, right, the fees that the fund is charging, the success rate goes from 29% down to 18%, shows just how important those fees actually are. So at this point, I think it's starting to become pretty clear that for the vast majority of investors, passively managed funds are going to be the better option, especially with a long-term time horizon. Now, one point of contention that I'd like to address is this idea that passive investing has somehow broken financial markets. And the idea behind it is that because so much money now is just tied to index funds and money isn't being allocated based on actual assessments of businesses and fundamentals, but just based off of whatever companies already make up an index. So the idea that some companies make up a larger portion of the index, those companies are going to become increasingly overvalued because they receive the lion's share of investor dollars that get allocated towards these passive funds. So fundamentals don't matter anymore. That's essentially the argument, especially as you get into larger and larger companies. So personally, I don't think this is true, and I think this can be disproven pretty easily as well. So this table that I'm showing you here, it's called 2024 Largest Gainers S&P 500. I actually showed this table in a previous video I made, and it is available on my website if you'd like to access this as well. It's just called tickernomics.com, and then just go to the public scripts feature here and then search for this script, and then you can run it and you'll get access to this table as well, which you can export into Excel if you'd like to do that. But basically what this does is it lists all the S&P 500 companies. It has some other data here, and then the last column is their year-to-date return so far in 2024. So I'll sort this so we can see what the worst performing S&P 500 companies are. So the worst one is a company called Globe Life Incorporated, but the second worst one is Tesla, right? Now Tesla was previously a trillion-dollar company, right? One of the biggest companies in the S&P 500 index. So if fundamentals don't matter anymore, how is it possible that Tesla is down almost 43% year to date? Well, it's down by that much because fundamentals have deteriorated, right? They've reported a few bad quarters and investors have reacted to that. So my point being is Tesla, previously a very large company, made up a very significant chunk of the index, has still managed to fall in price a lot despite this so-called passive investing bubble. And the reason it's down is because of fundamentals, right? It has nothing to do with passive investing. Investors are still reacting to the fundamentals, right? Now that's sure, that's just one example, but there's still plenty of other examples of large companies out there that are getting punished right now for showing poor performance. And I think it's very, very easy to just give a blanket statement and say that all of the Magnificent Seven companies are overvalued, and that's because of index investing. But show me some actual evidence that proves that those companies are overvalued. Personally, I don't think those companies are overvalued, right? They're very successful companies that make a ton of money. Maybe their valuations are a little stretched right now, but you can't definitively say they're overvalued. They actually look pretty fairly valued, in my opinion. So the point I'm trying to make here is I think unless we start to see instances where a company's valuation makes no sense relative to what the business fundamentals would indicate, then you can't really say that markets are broken because of passive investing, which is a pretty bold statement to throw around anyways. And to be honest, I think the people that are saying that, the people that are trying to perpetuate that narrative, don't even believe it's true themselves, because if they did, then for one, it'd be great news for them, right? Markets are broken, right? If you're a value investor, broken markets are, something that you would dream about because it's an opportunity to take advantage of mispricings in the market, right? And if they did believe it's true, then they could just pile their money into the biggest companies in the world that make up the lion's share of the S&P 500 index, because supposedly those companies would be getting a disproportionately large amount of fund flows and would go up in price even if the business itself starts to weaken, right? It seems like a pretty foolproof strategy. So but they're not doing that, right? So I don't think they believe that. And I think the reason that they're saying that is because these are people that run hedge funds, they run actively managed mutual funds, and their success is tied to people having this belief that you can get better returns through active management. And if people start to reject that idea, then that kind of threatens their whole business model. So lastly, let's look at my own firsthand data on actively managed ETFs. And I'm going to use my website, tickernomics.com, which does have a feature that we added on ETFs and mutual funds. So we have thousands of funds loaded on here with all kinds of data on them. So if you are interested in using this feature, again, link is in the description for this website. Now, my comparison is going to be a bit different than the Morningstar one because they compared the active funds to a benchmark that makes a little bit more sense to compare it to. For example, if it was a real estate actively managed fund, then they would compare it to a real estate related index and not necessarily the S&P 500 or a stock market index. But the way I'm looking at it is a bit different, and I'm looking at it from the perspective of a retail investor where we say, okay, we have all these different options out there for different active funds that focus on different asset classes. They all do different things, whether it's an energy focused one or it's a real estate focused one. What we ultimately care about is that risk reward trade off, right? And the reward is going to be any excess returns that we can get over what we would have gotten if we had invested in something else, like, say, a total world stock market index fund, which personally I think is what a lot of investors would end up picking. So I'm going to compare the performance of various actively managed equity funds to a fund called VT, which is the Vanguard Total World Stock Market Index Fund. And I'm not really using the S&P 500 as the benchmark. And the reason for that is many investors aren't only invested in the S&P 500, right? They probably also have some international diversification too, like you would get with a fund like VT. Now, the way I distinguish actively managed funds from passively managed funds was basically just by parsing through the fund descriptions that's loaded onto the website and just looking for where it would explicitly state whether or not it was passively managed or actively managed, because most funds will literally just state this is a passively managed fund or this is a actively managed fund. So it was actually pretty easy to do. And the vast majority of funds are going to be passive. I believe we had about 2,000 different funds on the website, and there's about 3 out of 4 would be passive, and then 1/4 would be actively managed. So I only included funds as well that had at least 3 years of data. So they've been live for 3 years because I wanted at least 3 years of performance history to look at. And I also excluded bond funds, right? Because again, we're just focusing on equities here. So the script that I created to get all this data, it's in the public scripts menu here, and it's called passive versus active ETFs. So I'll click run on this and you can see what the data looks like. And it basically just gives some pretty basic level data on actively managed and passively managed funds, like any dividends that they pay, what their expense ratios are, and things like that. So here's the chart here, and also the allocation between the percentage that goes towards equities and the percentage that goes to bonds. So I could remove the funds that were bond funds. And it also has their 3 year returns here, so we can see what that is. So you can export the data into Excel, which is what I did. So that's here. And then this tab here has all of the source level data, and this is just the summary that I put together. So I'll quickly talk about some interesting statistics that I noticed from this data. So to start, like I said before, around 3 out of 4 of the funds were passively managed funds versus the active ones, which is 24%. And then I also wanted to see the fees in passive versus active funds to see if they were actually higher, right? And again, it's pretty obvious that they are. So passively managed funds had an average fee, or I believe the median fee was 0.41%, and then for active it was 0.7%, which may not seem like a lot, but that different 0.3%, when you're talking about compounding over 20, 25, 30 years, that can certainly add up. And then I looked at the median 3 year returns, right, for passive versus active. And passive was 0.75%, active was 2.32%. Now, this may look a little low to begin with, but the reason this is the case is because I have included all of the bond funds in there. So a more accurate representation is, so we have this here, right? This is VT, the index that we're comparing everything to, and this is their 3 year return from April of 2021 to April of 2024. On an annualized basis, it was 4.12%. So let's look at the active funds, right? Because that's what we're interested in, right? How well are active funds performing relative to the other options out there, like a total world stock market index fund? How did they perform relative to that? Well, the percentage of the funds that outperformed VT, so they had better annualized returns of 4.12% over that 3 year period, was 53%. So actually, more often than not, the active funds outperformed, right? Which seems pretty good. And then 47% underperformed. Now, it's still roughly 50-50. I wouldn't say it's necessarily at a point where it would justify, trying to find a good active manager, because there's still the risk that you end up not finding one and you end up underperforming. And this is also without fees, right? And the reason I included it without fees versus with fees is I wanted to see what a difference the fees make. Because again, as I've said many times throughout this video, fees are very, very important. So with fees, it almost flips. Now we get to a point where only 45% of the active funds outperformed and the majority, 55%, underperformed, right? So that's obviously not good news. And again, it just shows what a difference those fees can make, even what seems like very minimal fees, like the median fee for active, which was 0.7%. So that was for VT. What about the S&P 500, right? Well, now the data looks even worse. The S&P 500 has done very well. We all know that. And over the last 3 years, the S&P 500 annualized return is about 8%. Only 11% of active funds outperformed that, and 89% underperformed. So when you look at it on the S&P 500, it looks even worse. And then in case anyone was curious, I also included what the best performing actively managed fund was, and it was one called InfraCap MLP ETF, which had 26.5% annualized returns for 3 years, right? And this is an energy focused ETF. We can actually quickly take a look what holdings those have in case people are curious. So this is the fund here. Its ticker is AMZA. And then if we look at the holdings, here are some of the companies that they own. So it's all energy companies. It's an energy focused one, and these seem like rather small energy companies. For example, there's Newstar here, Energy Transfer LP. I think that's a larger one. Kinder Morgan, that's another large one, but it's about 30 or so energy companies. Something else I was interested in exploring was basically the relationship between fees versus returns, right? So the reason I want to look at this is because in theory, funds that have higher fees should justify those higher fees with better returns. So is there any correlation in what's mapped on the x-axis here, which is the annualized 3 year return, and then the y-axis, which is the fund fees expressed as a percentage? So the answer is no. There's pretty much no correlation. I drew this trend line in between, and we can see it's almost a flat trend line, which means there's basically no correlation. So really, you should never think as a retail investor, higher fees means better performance, because at least in the time period I looked at, that doesn't really seem to be the case. So in conclusion, yes, there are some actively managed funds out there that have beaten the index over a multi-year period. So I would say active management has overall done well enough to justify the fact that it still exists. But again, the odds of you identifying those funds before they do that are quite low, and it's probably more so down to luck than anything else. And to answer the question of this video, which fund type is better, I think you already knew the answer to that. Passive is going to be the far better option for the vast majority of investors. But nonetheless, I hope this was an insightful look into some granular level data so you could get a deeper understanding and a deeper appreciation of just how the fund management industry works as a whole. But anyways, guys, that does it for this video. So thank you so much for listening. I hope you did enjoy it, and I'll see you in the next one.